Hi, everybody. Apologies for the slight delay there. We're about 5 minutes behind schedule. We just had a technical glitch, but everything is great now. Welcome, and I'm going to just get going right away now that we've taken up a little bit of time there on the front end. My name is Mark Noble, and I'm Head of Sales Strategy for Horizons ETFs, and I'd like to welcome you to Investing in Robotics, Automation, and AI. And this is the latest in our ongoing webinar series. You know, there's been two big trends in the ETF industry over the last couple of years. One is the rise of strategic, or what many refer to as smart beta indices. So these are indexed ETF strategies that are designed to generate more of an intelligent factor tilt beyond traditional indices. And then the other second theme, particularly in the last 2 years, is what we call the rise of thematic ETFs. And, you know, this is a great growth area of the ETF space where ETFs are seeking to capture emerging asset classes and other sector exposures that really haven't been captured by traditional classification systems or index systems. And clearly, as we know, when we look at our world today, there's many asset classes such as emerging technology, you know, certain types of commodity, Bitcoin, things like this, that people want to get exposure to. But the webinar today is, I think, an exemplary combination of how you can combine both of these really key concepts to investing to create one of the most compelling investment strategies that I believe we've ever been able to partner up on. So last week we launched the Horizons Robotics and Automation Index ETF, which trades under the Toronto Stock Exchange under ticker symbol ROBO, R-O-B-O. And at Horizons, we pride ourselves on being innovators, and so, of course, we've been looking to launch an ETF specifically focused on this space for the better part of the last year. And, you know, usually we do this kind of thing on our own, but when we did a review of our space, there was really no option in our mind than to launch this ETF with our partner, Robo Global. And the reason is simple. You know, Robo Global is an innovative index and research firm based out of the United States, which has coincidentally launched the fastest growing ETF strategy in the world, which is their ETF Robo listed on the NASDAQ. And as you'll hear from today's webinar, Robo Global is not your traditional index provider. You know, they're really a leading edge research firm along with an index provider who's kind of bringing top tier research and insights into the robotics and automation area. So, you know, I hope today when you listen to this webinar, you really get a good sense of what, you know, in what in my mind is probably the most transformative change in technology in our lifetime. And, you know, Robo Global has found a very comprehensive and effective way to get exposure to this seismic shift in the global economy. Now, I'm not going to take up any more time here other than to just mention a few housekeeping notes. Number one, please feel free to input any questions you may have in the Q&A box. Now, we likely won't get to those until the end of the presentation, but if you have any questions, if you think of something, if things go along, feel free to put that in. There's also a reference to a resource box that you'll see on the right side of your navigation, which has a product sheet as a backgrounder for the ETF, as well as a lineup of our ETFs. So without further ado, I'm going to put us on with our speaker, and our speaker today is William Studebaker, who's the president and CIO of Robo Global. And William is, you know, formerly prior to Robo, he was with Apex Capital and was the portfolio manager covering industrials. And for the previous 7 years to that, he had held a number of positions at Merrill Lynch, including a trader on the New York Stock Exchange floor, and most recently a director in institutional equity sales. But, you know, I love listening to William. I mean, this is a man who lives and breathes this space. I think you're in for a real treat today to hear about, as I said again, really a once-in-a-sort-of-generation investment opportunity. And I don't want to sound cheesy saying that. This is really interesting stuff. So I hope you'll stay on for the next 35 minutes and really hear about a space that you likely don't have a lot of exposure to, even if you think you do. So without any further ado, I'll pass it over to you, William.
Okay, thanks, Mark. It's a pleasure to be here this morning and convey our thoughts on a topic, an industry that we feel pretty passionate about. We're certainly very thankful to have partnered with Horizons. We think this is a very timely investment opportunity for particularly Canadian investors, given Canada's interest in establishing an industry around robotics and AI. I'm going to take about probably 25, 30 minutes to go through the slides. They'll go pretty quickly, and then we can address any questions you have in Q&A. But simply put, we think this is really one of the best investment opportunities available to investors. And the reason I say this is that recent advances in robotics, machine learning, and AI have put us on the cusp of a new automation age. And what's important for investors to understand here is that these are not niches, right? This is actually, as we like to define them, our foundational technologies that are now being applied to all industries, all markets, and it's happening now. And nearly 5 years ago, we created the first and only benchmark and index, along with our own proprietary industry classification system, to produce a well-diversified portfolio now of 84 names with pretty conservative characteristics. We'll get into this down in a few other slides. Very robust growth, and more importantly, the purity of exposure that we feel best captures what we define as RAY, megatrend, robotics, automation, artificial intelligence. And we did this with the help of some of the world's leading robotic thought leaders. I'll talk about our team as well. We have 5 PhDs in our team that specialize in this industry. And so performance has certainly been pretty impressive, up almost 50% year to date, better than almost all global indices. And we think this is a beat and raise trade for years to come. Shifting to the next slide. Mark, do I have to click on that, or?
Just push the yellow triangle there, William. To the next slide.
Okay. Oh, I see. I got you.
Yep.
So I guess, where are we right now? So today we are entering what we call Industry 4.0. And so what this is right now is the marriage of the physical and digital world. And the trend here is only going to accelerate as the digitalization of industries accelerates. And so technologies like robotics, AI, and machine learning really are desperately needed to survive in this new world, because there's really simply too much information moving too quickly for investors to process and understand. And AI simply offers the ability to process immense quantities of data in ways that we can't. And IoT, industrial Internet of Things, or industrial Internet of Things, really provides the mechanisms for generating this new data. What I'd like to kind of underscore here is that what's going on and why this period of time is so exciting is that the rate of change right now is truly exponential. And investors need to think this way, or they're probably likely going to be left behind. I mean, our brain is pretty excellent at extrapolating linearly, meaning that it's easy to predict where you'll end up after taking 30 linear steps. You'll basically be 30 meters away. But what happens when you take sort of 30 exponential steps, right? You're going from 1 to 2 to 4 to 8 to 16 to 32 and so on. So it gets harder. So predicting exponential growth isn't intuitive, but investors need to begin to have this understanding. This is a slide here that just shows kind of the rate of change. We've actually been automating for hundreds of years. Each industrial revolution we've had has been faster than the previous one. Here's an interesting depiction of New York City in 1900, and in 13 years later, seeing full adoption of mass production vehicles. And so that probably wasn't that intuitive back in 1900 that could happen. And I'm sure that there were a lot of blacksmiths that were worried about their jobs and what would happen. But we certainly absorbed that situation. And so, again, the rate of change continues to accelerate. Shifting gears, here's where we are now. A lot of talk now about autonomous vehicles. Definitely, I would say, was probably a Jetsons view only 2 and 3 years ago. But this is a technology that is highly disruptive, and it's going to change the world in pretty dramatic ways. Shifting here, again, kind of where we are now. Where we are here is now the result of computing power, which is essentially doubling every year and a half, and cost curves that are declining rapidly. So this has really resulted in an array of applications that were probably only considered science fiction a few years ago. And as we go forward with the progress we're seeing, we're going to see increasingly more use cases that are coming to market. I spent last week in Japan attending an industry conference and trade show, and I can tell you categorically there is an immense amount of disruption coming from technologies all over the world. this is what's happening now is not just isolated to North America. This is really truly a global phenomenon that's going on in terms of robotics, automation, and AI. If you're thinking about, the growth here, there's a lot of ways, to look at this. This is one depiction of the growth opportunity in robotics. Myriad Research identifies this as being a $1.2 trillion market by 2025. This is the hardware, software, and services of robotics. And while that's definitely a big number, to put some context behind this, I think it's almost always more useful to think about robotics from the bottoms up. And if you think about where we are in the evolution of this technology, in baseball parlance, we're not even in the first inning. I would say the players are in their locker room putting their shoes on. And that's why this is so exciting. Outside of industrial manufacturing, autos and consumer electronics, which is roughly about 40% penetrated, virtually every other industry is at very nascent beginnings or hasn't even started. I mean, we talk about autonomous vehicles, but we haven't even started yet. When you think about where the big growth is actually happening right now, it's no more apparent than in logistics warehouse automation. It's really the epicenter of automation right now. There is a robotics arms race that's going on there. And I think everyone can appreciate kind of what's happening. Amazon, in my mind, started this back in 2012 with their purchase of a technology called Kiva Systems, which is now Amazon Robotics. That's the 100,000 robots that do the fulfillment. Amazon had recognized that to be great at e-commerce, they need to be great at fulfillment. So they bought that technology. That has allowed them to cut down their fulfillment with humans from anywhere between 60 to 75 minutes to inside of 15 minutes. Everyone now has to be able to compete at the Amazon speed. And so there's no other way to do this other than for companies to begin to employ strategies using robotics, automation, AI. It's the only way to survive. Amazon is spending $50 billion the next 5 years on further automating and developing infrastructure around their businesses to support their customers. And so everyone has to compete here, particularly the bricks and mortars. And so when you think about the secular growth that is embedded here, it's probably 20% or greater for everything that ranges from picking and sorting systems, automatic retrieval, machine vision, trace, track, and control technologies. So pretty exciting, that segment of the economy. You think about where robots are being used in medical. Well, we can operate now with sub-millimeter accuracy. We're not going to 1 or 2% penetrations. Consumer in the home, we're probably less than 4 or 5% automated. I can go on, and if you have questions more on specific sectors, I can talk about that. But hopefully you guys have some appreciation that this is just very, very early beginnings. This is our team, and I can't really underscore the importance of the team we have. Not only were we fortunate to have identified the robotics, automation, and AI opportunity before most investors did, but we brought in some of the world's leading thought leaders to help advise us on the technologies and to create our first only classification system to identify these companies, which I will also get into. But just to talk about a few people, the gentleman on the top is Dr. Henrik Christensen, in my mind, one of the preeminent authorities in robotics and AI globally. He's the head of contextual robotics at UC San Diego. He is an advisor to governments and corporations globally on implementations. He authored what's called the U.S. Robotics Roadmap that he submitted to Obama and Congress, outlining basically the industry and where penetrations are and where they're going. Raf D'Andrea is a professor at ZTH in Switzerland. That's their MIT, if you will. He was actually one of the co-founders of Kiva Systems, which was sold to Amazon for $800 million back in 2012. He has immense knowledge on logistics automation and now on flying technologies. Dr. Ken Goldberg is at UC Berkeley, distinguished professor, has tremendous patent authorities in gripping and actuation systems. Manish Kahari is the head of the Stanford Research Institute, their ventures program. He's got a grassroots view of where a lot of technologies are being incubated. He ran their robotics platform. And then you can look at the rest of them. But just to give you some context here, it is a pretty distinguished team. And we think this gives us a pretty big competitive advantage in understanding the technologies. So just moving into, what we did and how we did it, so you guys have a sense for how the portfolio was created and what it is. So what we did is we were actually the first to have created the index and define the industry. And so while it was interesting to understand that robotics and AI would be an investable opportunity, at the time there really wasn't a way for us to capture that. There weren't any dedicated mutual funds focusing on this. There wasn't any really hedge funds, very little going on in private equity and so forth. So we sort of decided to take the tack of creating our own fund, if you will. And so what we did is that we went out to try to identify these companies. We recognized that there were some pure plays, but there were actually a lot of companies that were embedded into corporations that investors really hadn't thought about. And so we put our own classification scheme together where we identify a company as either a technology or an application. So the technology is simply what makes the robot work. It's the computing, the processing, the sensing, the actuation, the integration capabilities. That's the green concentric circles. Then the applications are really the use cases. And we've identified 8 use cases now, which I would anticipate will expand as the industry matures. But that ranges everything from warehouse logistics to industrial manufacturing, healthcare, food, ag, et cetera. And so what we have is a portfolio now of 84 names. It's global. It's 40% U.S. It's 60% international, not by design. This happens to be where the technologies exist. And so the real interesting appeal here is less than 2% of these companies are in traditional indices. And I think that's where it's pretty exciting, and we think this is where it resonates well in virtually almost any investor's portfolio because, again, these are companies that you all don't own. And here's just a brief description of the various technologies. You can sort of study that at your leisure. This is the applications. And what's interesting about this, and I think where investors tend to always get a little bit worried about technology, or they get confusion, is that often technology is hard to understand. It's certainly associated with high valuation and high volatilities and things like that. But what's interesting about Robo is if you actually look at the historical volatility and even the year-to-date volatility, it's exceptionally low. In fact, the historical volatility is around 11% in line with the market. Technologies, often have volatilities that are anywhere between, 15 to, 50, 60%. And so what's interesting here is that robotics touches all parts of the economy. So there's kind of a dampening impact on the vol. We talk about logistics warehouse automation where there's this tremendous secular growth. We've got, pretty secular growth going on now in healthcare, but we also have other areas that are sort of cyclically depressed, like energy and even additive manufacturing, which have had obviously a negative skew to the portfolio, but you kind of don't see this because you've got other parts of the portfolio that are doing well. And so again, while some sectors may be ebbing, others are flowing, and so we think that this is actually kind of an interesting characteristic to have. So this is the index construction process. How do we get to our 84 names? Well, we actually start out with a global database of 1,000 companies, both public and private. Of course, this portfolio is only public companies, but we do cover the industry. And so we like to stay on top of all the companies. But if you get in the index, a company has to fit within one of our 12 subsectors, and then we're looking for the companies that have the highest revenue purity to this exposure. So we are looking for companies that get the highest revenue exposure. We have only a 2-weight structure. I'll talk about that in a second, but we have either what we call a bellwether, which is, I'll just move this quickly and I'll come right back. We have what's called a bellwether, which is 40% of the portfolio, or a non-bellwether is 60% of the portfolio. Those are fixed parameters. A bellwether company has on average between 60 and 70% of revenue that comes directly from robotics, automation, AI. Again, we're sort of going to the gold rush with the picks and shovels. So it's not the companies that are using those technologies to enable their business, but the companies that are selling these technologies. Non-bellwethers have, on balance, roughly around 25% revenue exposure. But the bellwethers, certainly there's some that there's 100% purity. And so shifting back to then the index, we're looking for the companies with the highest revenue exposure. We're certainly looking for companies that we think have a moat around their business and a technological advantage and that are leaders. And so we then submit a list to our calculation agent of the names that we find having the highest relevance. And then the portfolio is then passively screened for everything from index eligibility market eligibility to then minimum market cap, volume. We have an ESG filter that's also applied, and we have a maximum position size. We can have no more than 5% of the free float. So it gives the index some capacity as we grow. It touched on the weighting structure. So again, what was kind of important here for investors to realize is that we wanted to design this index to be simple and transparent and not confuse investors with a bunch of factors. We wanted to produce a exposure that gives investors access to the entire global value chain of robotics, automation, and AI. Again, recognizing this is very much global. If you had just access in the U.S., you would miss a huge part of the value chain. We also recognize there's going to be a lot of disruption. So to pick the obvious winners and losers, we think is going to be very difficult, which is why we chose to pick the position weightings that we have. In hindsight, I think everyone is an expert on companies like Amazon, NVIDIA, probably not exactly household names, 5, 10, 15 years ago. These companies have evolved. I think that's the case. It's going to happen here. Again, way too early to pick the obvious winners and losers. If you look at historically, getting the sector right is probably just as important as getting the stocks right, if not more. We did study, as an example, the IDB index, the biotech, from the summer of, I guess it was the beginning of 2012 to the summer of 15. The index went up nearly 300%. It was interesting to observe that only 15% of the companies outperformed the IDB. There was a few really storied stocks like Regeneron and ICPT that had parabolic moves that everyone wished that they had owned. It was interesting that if 15% of the index outperformed, that meant that 85% of them didn't. If your stock selection was unfortunate, there was actually 25% of the companies had a negative return. So, certainly God help you being invested in the best performing subsector of the economy or the S&P. You could have had kind of an embarrassingly poor return. And so, again, disruption is difficult for a lot of investors to track and participate in. The reason to invest and why we're so excited here is the growth, dramatically higher growth than global indices. These are not our estimates, or actually Bloomberg estimates, sell-side estimates. The sell-side, tends to not have very optimistic estimates. They tend to kind of move their estimates up as the company reports and gives their outlook. 64% earnings growth for the next till the end of 2019 is the Bloomberg estimate, and so we're pretty excited that the growth is pretty apparent here. It is interesting with our index this year. We've seen an undeniable inflection point in the performance of our companies. There has been a sequential earnings growth in each quarter moving out throughout the year from, I believe it was around 21% earnings growth in the first quarter to 24, and I believe it was 25 or 26% in the third quarter. So growth continues to accelerate. This is the the portfolio characteristics. 30 times trailing earnings. Actually, on current year earnings, it's around 26 times earnings. On forward earnings, looking out to 2018, the index is around 23 and a half times earnings. So definitely not the sort of nosebleed valuations that some people would associate with technology. The real appeal here, obviously, is the low overlap with traditional indices, extremely low, volatility, and we think, again, this is sort of a beat and raise trade, for years to come. When you think about, where this could be positioned in investors' portfolios, we certainly, to back up Mark's point from the beginning of his introduction, this is definitely thematic. It's certainly global growth. It's technology. It's also 75% mid and small caps, so that could there could be a space for investors if they wanted to position it there. And it certainly could be within international. It's 40% U.S. and 60% international. We think regardless of where investors position their portfolio, it's alpha, it's new growth, and we think any and all investors would be well advised to have between 5 and 10% of their portfolio allocated to what we believe is the new sources of growth. If you do look at Robo relative to the FDN ETF, which is the FANG companies, which has a 50% weight of the FANG companies and then a few other internet-related companies as well, Robo's outperformed the FDN the last 52 weeks by roughly 600 basis points, and maybe a little bit more. I haven't checked it recently. But that's despite the fact also that Robo trades at a 20% PE discount to the FDN ETF, as well as a 40% price-to-book, price-to-sales discount. So it's new growth, and it's actually cheaper valuation. And so that's kind of my prepared remarks, and happy to take any questions.
Hi there, it's Mark on here. Just going to quickly, we're going to quickly move to the Q&A in a few minutes. Just wanted to highlight a couple more things. William, thank you so much for your comments on the construction of the index. With regards to, when we launch an ETF, we typically launch an index and, there's a back test on the index that looks phenomenal. One of the really interesting things about this product is this product in the United States has been live since 2013, I believe. So a lot of this performance is real performance. This isn't necessarily hypothetical. Of course, we say hypothetical up here because it goes back to the original inception of the index in 2002. But if you look at sort of the post-2014 performance on this slide versus the MSCI, versus the NASDAQ, versus the S&P 500, you see that there's a real realization of that this theme is real. And I know that we'll probably touch on it, but I mean, these companies are generating real revenues. The earnings side of their business is growing exponentially, which is why we're seeing this fundamental growth in this subsector of stock. So clearly, as you can see here, being in this subsector, this thematic aspect, which is really bigger than a theme. I mean, this is transformative, right? I mean, you can have themes like, blockchain or social media. This is transformative. Everything we do on a daily basis is impacted by this automation theme, and I think this is really what's showing this big drive in performance that we've seen over the last 2 years. For compliance reasons, yeah, go ahead.
Mark, what I was going to say, what's important for investors to recognize is that we try to eliminate a lot of idiosyncratic risks that could be inherent in companies by not putting what I call science fair experiments into the portfolio or into the index. For a company to go in the index, it has to have real revenue exposure to the industry. We only have a few companies that aren't generating positive earnings right now, but we're expecting them to in the coming quarters. And so we try to eliminate that. We're not going to put in a company that has a prototype technology that might work. We're not putting in a medical related technology, for example, that we're hoping that's going to get FDA approval. So we're scrubbing these companies pretty aggressively. Again, there is a lot of disruption coming. There's a lot of growth that's going to be coming here. Just to give some historical context, since 2012, there have been 1,200 venture fundings in AI and over 200 acquisitions. There's been 400 to 500 venture fundings in robotics since 2012, and 176 startups in robotics last year alone. So there's a lot of companies that investors have to sift through. This is a pretty dynamic sector to follow.
Perfect. Just from our area, just from the Horizons perspective, I mean, these are some key reasons to own Robo. And I do want to highlight, obviously, there's a very successful existing U.S. ETF, Robo NASDAQ in the United States. And if you have U.S. dollar investments and you want to direct U.S. dollar exposure, I can't recommend products, but I strongly suggest that you take a look at that ETF, how well it's done, the amount of liquidity that's there for U.S. dollar. But we recognize from a Canadian perspective that there was probably a need for a currency hedge version here in Canada because, this is a global thematic play based on the growth of the stocks, not necessarily a growth on a geography. It's not like you're investing specifically in something where you want to capture the currency move. So our big value add here is that we've launched this product in Canada with a currency hedge. So it's designed specifically for Canadian investors, but there is really two ways for you to look at investing. If you're using US dollar accounts, you can look at Robo NASDAQ. If you're using Canadian dollar investment accounts, you can look at Robo TSE or Toronto Stock Exchange. So there's a 1-2 punch in terms of cross-border. Clearly, there's a growth opportunity here. This is one of the fastest segments of the global economy. One of the things that shocks me is there's stocks in there like John Deere, for example, which, you think is a traditional tractor company, but have moved heavily towards, automation of farming, like the agriculture. Farming is being disrupted. We're seeing fridge being disrupted. So this growing segment of the global economy is all being captured in this strategy. Diversification. There's little overlap in holdings. And this is the other big reason we wanted to bring this to Canada, because we have two diversification issues in Canada. Number one, the majority of Canadians, 85% of their stocks are in North America, with about 60% of that in Canada. So they don't have any, very little exposure outside of Canada. This is a global mandate. Secondly, if you're benchmarked just to Canada, you have virtually no exposure to this sector whatsoever. I believe there's one Canadian stock in this index. So you just, I would gander that if you look at the holdings of the index, which you can find, on the Horizons ETF's website, you likely don't have exposure to a large cross section of this. Big value add for us is working with the innovative index design of Robo. What I love about what the Robo Global team is doing is they're doing a qualitative assessment of that these stocks are actually in this space. As you can appreciate, in a space that's moving as quickly as this is, finding stocks that are making meaningful investment and being leaders in this area is in itself a huge research undertaking. And that's why we've partnered with Robo. We can't do this with a traditional index provider because they don't have the repository of intellectual capital that Robo does and experience that Robo does in finding these stocks. And as I mentioned, currency hedge. So I know we did have a question already come in about the currency hedge. All U.S. dollar exposure, which is your primary liability as an investor over a cross-border, is hedged back to the Canadian dollar. So that's really the key differential between our ETF and the Robo NASDAQ ETF. The two are effectively the same strategy, but with ours, you'll have that hedge on the U.S. dollar exposure. So just hitting up these final pieces here in terms of the product details, and I think we'll move into the Q&A. I know we've already got some questions here queued up, William, so I'll get going on that right away. Great question here in terms of, and I think this goes back to really why we've partnered to you. William, what level of involvement does your advisory board have with the operations and, the index selection of your product?
Well, it's a great question. They have a significant and meaningful impact and contribution to our business on a daily basis. First of all, they're all highly compensated. They're not doing this for free. 4 of the 5 advisors actually have an equity stake in the company, so they're heavily motivated. They are instrumental in advising us on the technologies and the applications They participate on all of our index rebalancings. I did fail to mention that the index rebalances quarterly, so we rebalance back to a 1 to 2% position each quarter. That's obviously the opportunity that we can evaluate, new technologies. And so they all participate on the index selection process. They do a tremendous amount with us in terms of investor engagements. We do a lot of presentations, webinars, and education with investors. And so I basically communicate with the advisors on a weekly basis, and our whole team does.
Awesome. And I have another question here. Do you have any sense of, what sort of areas of Asia are you investing in? I think that does pop up in people's radar that there's a fairly significant weight in Asia. What are the regions and sort of areas that Asia is sort of generating from a robotics and automation sectors?
Well, clearly the growth in Asia is pretty transparent and pretty pronounced. Having just spent a week in Japan last week, it's interesting. In North America, I'd say the sort of context around robotics tends to be fear the robots, whereas in Asia, it's embrace the robots. They recognize that this is a way for them to, and I'm not joking by this, I mean, they clearly think about robotics and AI as a way to help make their lives faster, easier, simpler. There is a chronic age issue going on in parts of Asia, in Japan in particular. Over 30% of the working population by 2030 will be over 65, and so there's an issue on getting qualified, workers, and also on managing the healthcare related, liabilities. So our participation, the index has about 25% exposure in Japan. There's also exposure in Korea, into Hong Kong, Taiwan, and China. I mean, China really is shifting to become really kind of the epicenter of robotics. We don't have any local shares in the index right now. We have one company that's in the index, but keep posted there. There's several hundred robotic companies in China presently. A lot of them are sort of, state funded, but they have some interesting public companies, and so there's a lot going on. Our index, just in China, in terms of revenue growth, has around 13 to 15% of the revenues from the index come from China alone.
That's unbelievable. That's just huge. Another question that we get from people is, they own Qualcomm, maybe they own Nvidia, they own Amazon, and they view that as sort of, their bulwark of capturing this trend. What would you say to investors that, think that they already have that exposure through sort of the big FANG stocks and maybe a Qualcomm and Nvidia? And what's the benefit of diversifying outside of those stocks with the ones in your index?
Well, again, as it relates to Amazon, we don't really qualify Amazon to be in our index. Amazon is not selling robotic and AI technologies. It's granted they're selling, Alexas, but they're basically just using these technologies better than anyone to enable their business. In fact, the FANG companies really are the biggest ambassadors for where the world's going. They're defining themselves as being AI-first companies, and they're using AI to better manage their company. So I think that's, one distinction investors need to have. The ecosystem here, again, is much broader than most people think about. And if I was to go through the list of where our top performers have come from, I would doubt many people, would recognize these companies. But there are a lot of technologies that are supporting robotics and AI, right? It's everything that comes with machine vision, right? You're talking about technologies in sensing, in actuation. Actuation is a critical area in robotics and AI. That's what allows, or in robotics, it allows robots to move with sub-millimeter accuracy. There's two companies in Japan that pretty much have a global duopoly. One company is called Harmonic Drive. That stock, interestingly, since inception of the index, is up almost 600%. again, a lot of companies that most investors, haven't heard about. We have companies in our index now like Young in Korea that's a little under a $2 billion market cap that has disruptive technologies in 3D sensing. So again, to have some AI technology like NVIDIA is great, but there's a lot of other emerging companies. We have companies like Ambarella, AMBA is the ticker, that I think is a pretty interesting story that over the next 2 to 3 years I think is going to be revalued as more of a computer vision company for autos and the drone industry. Presently, it's probably more associated with its exposure to GoPro than anything else, but they are basically shifting their technology focus. So, I have a long-winded answer. I hope I answered your question.
No, I mean that was a perfect answer. I think it's really important people understand, as you mentioned, that they have the picks and shovels. These are the ground level of the technology being developed and then being used by power users such as the FANG stocks. One final question I think it's really important to touch on, and it was a great question, is unlike early days of internet, I mean the one thing that you see with these stocks is these are revenue positive stocks. These are already viable businesses. This isn't investing on a hope and a prayer. There's actually some fundamental growth here. Would that be accurate, William?
Oh, clearly. I mean, there is no comparison to the internet days here. Internet days was hyped, right? I mean, we were valuing companies on clicks. We're valuing companies on revenue, EBITDA, and earnings here. And what's interesting about the internet transformed a few different parts of the economy. But robotics and AI will transform every single industry. Bill Gates said it best back in 2013 when he expected robotics to be as ubiquitous as computers and more transformative than the internet. More recently, Jeff Bezos has stated that the way he looks at AI, it's a true renaissance period. And why that is because our computing power is going through the roof. Our costs are going down. We're generating massive amount of fuel that fires this, which is data. The only way, to dissect the data with the accuracy we need is with the AI and with computers. And so it's really pretty exciting. When you think about just the technology, NVIDIA came out with their new AI driving computer, the Pascal, that does 320 trillion calculations in a second. So this is the type of technology that is now coming to bear.
Fantastic. We're now at our almost our 11:50 mark, so I am going to wrap up this webinar. You can see on our Contact Us page, you can reach us with any further questions you may have. I noticed that the vast majority of attendees on today's call are financial advisors, almost 100% actually, which is great. So you do have wholesalers that you can reach out to for your respective territories. If for whatever reason you don't know who that is, you can also reach us directly at info@horizonsetfs.com. Once again, William, I want to thank you for being on this call. I really do feel like the future is now. The moment of disruption is here. And so, this is a really interesting additive to a portfolio strategy going into 2018. And, we hope that, you'll be part of the success as we see this space move forward. So once again, thank you to William. Thank you to everybody else. And have a great rest of the day.
Thank you.
All right. Take care.